Hello, students. Today I want to consider a question that deals with uh, national income. And this question was tested in April 23rd of 2024 in economics paper, which was taken by students, CPA students and CFA students at foundation level of CASNEB exams. Now, the question of interest is question 3, and it asks, part 1, if I should enlarge so that it's clear. Yeah. Explain the term monetary policy. That is 2 marks. Then identify 4 objectives of fiscal policies. Then the following information relates to a given economy. Marginal propensity to save, that is MPS, is 0.2. Autonomous consumption is 400. Now you are required to formulate the consumption function, that is 3 marks. Then determine the change in national income if the government's expenditure was to increase by 50%. Using an appropriate diagram, explain 4 properties of indifference curves, 8 marks. So that's the question that we want to consider today, and it's only prudent that straight away I get there. So as we see, the paper is question 3, as we have seen, and let's consider what our solutions look like. 1, what is a monetary policy? We say this refers to the actions taken by a country's central bank to control the money supply, to control interest rates, and to control inflation. Now, the main aim is to achieve economic objectives like controlling inflation, managing employment levels, and maintaining financial stability. Now, that being the definition, we know that this is one of the tools that the central bank uses to influence the environment under which the forces of demand and supply operate to dictate what interest rate to charge at what time, depending on the demand for money. Now, the balance, there is also need to be a balance, so that as much as at some point, because there's need, when you are dealing with demand and supply, these are curves that normally they seek to achieve equilibrium. It means that one may go beyond, that is way up or way below. But every time as they oscillate as they seek a point of equilibrium. It then means that these policies will be applied alternately. There will be a situation where the time will require that you reduce money supply. Then there are times when situations require that you increase money supply. But all this we do with inflation in mind. So that is the definition for monetary policy. The second one asked us to give objectives of fiscal policy. Fiscal policies, again, these are also measures that can be introduced into an economy through reducing government expenditure, government spendings, and also by through taxation. And we have seen that these particular policies normally they're introduced with particular objectives in mind. So one of the objectives why we see some of this, or we feel the effect of some of these policies whenever a budget is read, is they seek to stimulate economic growth. So stimulating economic activity through government spending and taxation to promote a healthy economy. So by increasing government spending, that is seen to increase disposable income of the populace, so of the population, so that they are able to, if they spend, if money is flowing, then the economy is considered to be healthy. Now, that is a case where government spending should be encouraged. Then we have a case of full employment. Of course, we also have taxation here because we will say stimulating economic activity through government spending and taxation to promote a healthy economy. Then full employment. Full employment here is fiscal policies aim to create jobs and reduce unemployment through government initiatives and investments. So, for instance, taxation can be geared in a manner that it creates a conducive environment for investment. And if investment is encouraged in an economy, then the net result is that those investments will require labor, and that will ensure that employment is encouraged. But here we are not only keen on employment of the human person. When we consider factors of production, we also have capital. So having capital lie idle, again, that is an employment of capital. So we should be mindful of ensuring that both human labor and capital is engaged. So when we say full employment, here we are talking about labor, but I'm also trying to highlight that when labor is engaged, then to some extent, capital is also engaged in equal measure. The third objective is price stability. Now, we said that we have demand pull inflation and demand push inflation. So controlling inflation and deflation to maintain stable prices and purchasing power. The more we have our inflation skyrocket, then it means the value of our currency will go down. And that's a reason to worry because we do business in international market. So that should be a reason to worry. And whenever we make our value source, if we control inflation to an extent that we make our currency scarce, that means the value goes up. Again, to some extent, that is good, but in terms of observing BOPs, again, that brings a deficit, which is not desired. Then redistribution of income. Now, through taxation, it is possible to tax those who earn more in the society. And also, there are also players who operate in complicated, sophisticated markets like monopolists. By imposing high taxes on them, such taxes can then be redistributed to offer some social services that are common to everyone. So in that light, such fiscal policies, a number of times, their objective mean good to the economy. Then there was this question. We were given marginal propensity to save, which is 0.2. Then we also given autonomous consumption, which is 400. Now in this question, I've provided the solution as it is. I want to explain it, but you'll need to take a paper and pen and try work it out to see if you get this. Now, I have marginal propensity to save, which is 0.2, autonomous consumption, which is 400. Now, the consumption function can be expressed as C, which is the total consumption, is equal to autonomous consumption, which is 400, plus marginal propensity to consume times Y. So MPC is marginal propensity to consume. But we should remember, or we know, that marginal propensity to save plus marginal propensity to consume should be 1. Because in an economy, there are only 2 things. It's either you are consuming or you are saving. So we are saying MPS plus MPC should be 1. So if we are already given MPS to be 0.2, it implies that MPC is 0.8. Then we can then come and substitute that in our equation here. So C is the total consumption. A is autonomous consumption, which is 400. We put it here. C is just C, total consumption. 400 is autonomous consumption, which is this. Then MPC is 0.8. We put it here. Then Y is the Y, and Y is defined as national income. Thus, the function, the consumption function is given as 400 plus 0.8 of the national income. Now, the second part required us to determine the change in national income if government expenditure increases by 50%. So first, what we need to remember is that we have what we refer to as a multiplier effect. And multiplier effect normally is given by, it's actually the reciprocal of marginal propensity to save. So if our marginal propensity to save was 0.2, then it means our K is 5. And again, here I need you to take a pen and a piece of paper and work it out and see to it that you're getting the values that I've given, that I'm showing on this screen. So the formula for the change in national income, which I'll put as delta Y, which I'll put as delta Y, due to a change. So the formula for the change in national income, which is delta Y, due to a change in government expenditure, that is delta G, is delta Y, that is change in national income, is equal to the multiplier effect times change in government expenditure. But we should remember that if the government expenditure increases by 50%, then we assume that the initial government expenditure was G, which again is already implied here. Then the change in government expenditure would be, change in G would be 0.5 of G. So I bring 0.5, this 0.5, I carry it and put it here. So I have 5 times 0.5 G. That's what I have here, 5 times 0.5 G. And that tells me that the change in national income is 2.5. And what that implies is that the national income will increase by 2.5 times the initial government expenditure. And that is the answer. So take your time and look at it. Take a piece of paper and a pen, work through it and see to it that you get this value and understand its interpretation. Now, indifference curves. Now, indifference curves represent combination of two goods that provide the same level of satisfaction to a consumer. Now, the properties are, one, they are downward sloping. They are downward sloping. They are convex to, just a moment. First, we see that they are downward sloping, convex to the origin, non-intersecting. Higher curves represent higher utility. So I want us to see this. This is the indifference curve. That's the diagram. We see that this is good Y and this is good X. So we refer to this as indifference map. It's not an indifference curve because it has in it different curves. So we call it an indifference map. If we only had one indifference curve, we would have called it an indifference curve. But now this is an indifference map. And I'm using an indifference map so that we see the difference to bring out the 4 properties. So the first property is that they are downward sloping. You can see that if, for instance, I take this value of good Y, then the only combination of good X I can take is this. You draw a straight line here, horizontal, vertical. So for that value, only for that value of Y, only this value of X. So by taking this value of Y and this value of X, then there is satisfaction obtained. Should you reduce the value of Y to take, then it means you are increasing the value of X. By reducing the value of x, you are increasing the value of y. That's what happens. So I made this point using the higher curve, and that is what brings the aspect of downward sloping, like the demand curve. Now, it is convex to the origin. That we can see by the shape because of the substitution effect that happens. If you take more of y, you have to reduce to give up some of x in order to get more of y. Yeah, like that. Then they are non-intersecting. As you can see, the indifference curves are different. They're just different as the name, as the name almost suggests. So they can't intersect because as much as they are curved, the space between them most of the time will be equal, so that they'll never be intersecting. So you can think of them as being parallel, as much as they are not. They are curves which are parallel. Yeah, by going by this diagram. Then higher indifference curve gives a higher return. Definitely, if say you take a line, draw a line here, straight up to here, then give a combination of x, where you got your line, give another combination of x, give another combination of x. So you'll be having x, 3 different combinations of x and y. In whichever case, if you compare them, you'll still realize that IC3 gives you the best return. So that's what it means. So there are only 4 properties. 1, the downward sloping, convex to the origin, non-intersecting, then higher indifference curve gives higher returns. Now, here is what we have. So IC1, IC2 are indifference curves. Each curve represents a combination of good x and good y that provides the same satisfaction. So higher curves like IC3 represent high utility levels. They slope downward, reflecting that to maintain the same satisfaction, if you consume more of good x, you need less of good y. They are convex, reflecting diminishing marginal rate of institution. Now, this aspect of diminishing marginal rate of institution, we'll see what is implied when we'll be making calculation at that point, the convex point, using some tangents. At that point, as much as it's a curve, it's convex, it's possible to stop at some particular points along that particular curve using tangents, and that will give us much information about marginal rate of substitution. So I think this up to here, that's what I want to consider. And I know there may be more that I may not have explained as you may have expected. But that's the reason why I encourage you every other time to leave a comment down so that I know what I need to improve on, what I need to talk about in my next class. Up to there, my YouTube channel is Exam Prep WhatApp, and WhatsApp 0790011681. You can email me to collinsforonlineteaching@gmail.com. Thank you, and see you in my next video.